India's external debt just climbed to a record level, and it's rising at the fastest pace in 7 years. Some people say this proves India's growing global credibility. Others warn it's a financial time bomb waiting to go off. So, which is it? Let's break it down. Look, debt isn't some evil word. You and I borrow all the time, for houses, cars, maybe even college. Governments and companies do it too. Here's the difference. When you borrow inside your own country, you're paying back in your own currency, manageable. But when you borrow from outside, you're suddenly at the mercy of the dollar, global markets, and investors who don't care about your domestic problems. One bad swing in exchange rates, and your repayments can double overnight. So, what's the picture in India right now? As of March 2025, India's external debt stands at $736 billion. Just a year earlier, it was $668 billion. That's an increase of nearly $67.5 billion, a 10.1% jump. In rupee terms, it's even heavier, about 63 lakh crore rupees. Why? Because the rupee lost ground against the dollar, slipping from about 83 rupees to nearly 90 rupees in that time. Every weaker rupee means India has to cough up more for the same dollar loan. The debt-to-GDP ratio also ticked up from 18.5% to 19.1%. Now, that's not scary compared to many other countries, but the pace, that's what economists are side-eyeing right now. If you like this content, don't forget to hit like and subscribe. We share in-depth stories like this all the time, and ye can always dive deeper into the details on our website. Let's unpack where this debt be coming from, because not all debt be created equal. Commercial borrowings, mostly by private companies, rose by over $41 billion. That's Reliance, Adani, Tata, and others tapping global markets. NRI deposits grew too. When non-resident Indians stash money in Indian banks, they can pull it back abroad whenever they want. Which means, technically, it counts as external debt, short-term trade credit. The money that finances imports and exports jumped by $18 billion. And here's the red flag. 41% of India's external debt is now short-term, due within a year. That's like juggling payday loans. Risky. Government borrowings from multilateral agencies like the World Bank and Asian Development Bank increased, but at a much slower pace compared to private sector debt. So why the big jump? A cocktail of reasons. 1. Imports skyrocketed. Oil, electronics, gold, you name it. When you import more than you export, you need dollars to pay the bill. 2. Current account deficit widened. Basically, India's spending abroad outpaced what it was earning. 3. Corporate strategy. Indian companies found borrowing abroad cheaper than taking loans domestically, so they loaded up. 4. Rupee depreciation. The weaker the rupee, the bigger the debt mountain looks in local terms. Global confidence. Ironically, one reason investors are still happy to lend is because India looks more stable than many emerging markets. In other words, lenders trust India won't default. But here's the irony. We frown at personal debt, yet economies literally run on it. The trick is why you borrow. If you take a loan to buy a house, that house holds value. But if you max out your card to throw a massive party, the hangover lasts longer than the fun. India's challenge is the same. Use this debt for building highways, factories, power plants, things that create jobs and revenue, not for patching short-term holes like paying salaries or covering subsidies. Think of India's debt like weight gain. A couple of pounds, no big deal, especially if you're working out and building muscle. But if the scale shoots up every single month, your doctor's gonna raise a red flag. That's where India is. Healthy for now, but there are three big risks here. 1. Currency risk. If the dollar strengthens and the rupee weakens further, repayment costs balloon. 2. Rollover risk. With so much short-term debt, India constantly has to refinance. What happens if global liquidity tightens? 3. Debt sustainability. Right now, 19% of GDP isn't alarming. But if growth slows while debt piles up, that equation can get ugly fast. But it's not all doom and gloom. There are solid cushions too. India's forex reserves are massive, nearly $700 billion. That's like having a war chest covering 90% of all external debt. Debt service ratio, how much debt payments eat into export earnings, is still manageable thanks to strong remittances from Indians abroad. Borrowing sources are diversified. India isn't dependent on one lender. It's a mix: commercial, bilateral, multilateral NRI deposits. And don't forget, India's economy is still growing at one of the fastest rates in the world. Growth makes debts more bearable. So here's the big picture. India's external debt is rising fast, but it's not spiraling out of control. The world is still betting on India's growth story, and that's why lenders are lining up. The real question is, will India use this debt to power long-term development or waste it on short-term fixes? That's the difference between building wealth and piling up problems. Now I want to hear from ye. Which do ye think matters most for India right now? R. Strengthening the rupee. 2. Building even bigger forex reserves. Or 3. Boosting remittances from Indians abroad. Drop your answer in the comments. I'll be checking. And hey, if you enjoyed this breakdown, don't forget to like and subscribe. We share stories like this all the time, and ye can read more details on our website. Arr.